How in the world did a portfolio go from being up $3,000 to down nearly $2,000 in just 1 week? We're going to explore what in the world happened and how we're going to position the portfolio going forward. Now, what I want to do is basically just to compare the open stock position that we have just to see our portfolio value. Now, you can see basically last week we had about $13,500 in cash. We had PayPal stock, 20 of it at $65. So basically that's $1,003. 500 SoFi shares at $750, so that's $3,700 . So you add on the SQQH that we eventually sold in the middle of the week. Basically we sold it at 72 cents. So you add all of that together, you can actually get a portfolio value of about $18,900. However, because Moomoo actually does this thing where they net off the cash secured put premium, right? However, what I'm going to do is for the ease of calculation and comparison, I'm going to ignore the cash secured put because for our strategy, largely what we're going to do is we are going to actually roll it out if it actually gets too close for comfort. Otherwise, if we actually do take a loss, it's going to be reflected in the cash. So there's no point of me counting it in right now. So I'm just going to compare the open stock position. So if you look at it this week, basically all we have left is this Intel position over here. We have 100 shares of Intel. These 100 shares of Intel worth about $19.71 each. And then basically we have the same 500 SoFi shares, but today it's actually only worth $6.64. You see our cash position basically dropped to 11,445, and basically we'll talk about this in the video later on. So if you add the cash position that we have along with the Intel shares and SoFi shares, basically you can see the net account value now is about $16,700. So if you remember, we started this account with $15,400. Today, at least we are still at $16,700. We're still up $1,300. And that is the beauty of the wheel strategy. When you run the wheel strategy, the good thing about having all these premiums and things like that is you actually realize a profit, because otherwise you're just holding shares. And then this is what I call dead money, because the shares are there. Yes, it may go up and may go down, but all these are just paper gains and paper losses, and you don't actually realize any profit. Because we realize profits along the way, you can still see the profit in the account despite the swings in the portfolio value because of the market conditions and because of the aggressive Intel puts. So basically, if you look at the transaction, I basically sold the 20 PayPal shares at $60.17. We actually bought it at $59.19, I think, if I never remember wrongly. Let me take a look. Our cost basis was $59.19, so basically we made about $1 per share, so only $20, nothing much, but basically we still made $20. We sold it more or less at break even. Okay, and then after that, when I was actually selling the SoFi put, I actually, in a sense, accidentally sold the $10 put instead of $8 put. Thankfully, I actually managed to get out at a $50 profit after the swing in the market. Before we take a look at the portfolio, let's talk about some macroeconomic factors facing us. Now, for a deeper dive, I'm going to link a video over here, which I basically talked about yesterday. However, just broadly speaking, there are three things that are worrying us. We're actually worried about, slowing down in consumer demand, lower demand, weaker consumer, basically causing a recession. That's the first thing. Second thing we're actually worried about is the unwinding of the Japanese carry trade. You actually saw part of that happen on Monday. A lot of news reports actually come out and tell us that, hey, you know what, we're actually only about 40-50% done, so there's still some ways to go. And then when the Federal Reserve actually lowers the interest rate, that is going to, possibly reanimate the whole Japanese carry trade again. There's still something that we are concerned about and still to be seen what's going to happen as the Federal Reserve lowers the interest rate. And the third thing, I think, coming into this week, we're actually looking at the PPI and CPI data. So if I actually look at the forecast, so for July, core PPI is projected to be about 0.2% year over year. Basically on an annualized basis, and then for CPI, core CPI, we're looking to come in at 0.2%. So basically, softer inflation rate. CPI year over year is looking to come in at around 3.2%. If we do come in lower, the markets may react happily to that. Now, first things first, you can take a look over here. Basically, I have about 100 Intel shares and a covered call sold against them. So basically, what happened was the 5 cash secured puts, right? We ended up closing 4 of them and keeping 1. This 1 cash secured put, basically, it was due on the 30th of August, but we ended up getting assigned early. So at this point, right, some of you may be like, you actually got assigned earlier, so much in advance, some more 2 to 3 weeks in advance. And the answer is yes, we basically got assigned so early. And at this point, you may be freaking out. You're saying, hey, isn't it then very dangerous? Well, I think I want to allay your fears by telling you that, in every investing strategy, right, carries some form of risk. Now, if those people that tell you, no, there's no risk or there's low risk, right, you better run far, far away, because that's not the correct mindset to have. When we invest, we want to actually understand the risks that are involved and take the correct risk management strategy in order to mitigate the risk as far as possible. So in the case of the wheeling strategy, basically there's 2 risks that's involved. Number one being too premium greedy. Basically, we're just selling cash secured puts all over the place, even if we do not have the capital to buy the shares. So the dangers of that, right, is basically the current positions that you're holding, you are forced to liquidate them in order to buy the new position that you get assigned to. And the problem with that is usually the position that you're holding is usually a high conviction stock, right? So you end up missing out on capital gain on that stock, buying into a position that likely you're already in a losing position, and then you basically have to work your way up again. So that's the first risk involved. Second risk involved is basically you're not sure, whether or not you're in danger of early early assignment and then you get caught off guard, you get caught by surprise and things like that, and you don't have the money inside the account. So this problem actually can be very easily mitigated by understanding how to look at options. Basically, I'm going to link a video over here. Depending on when you're watching this, I may look like I'm pointing into the air, but basically what I'm doing is that I'm going to link a video over here teaching you how to tell whether or not your options will expire early. Now with that, back to the Intel position. So basically what happened, like I said, I closed 4 out of the 5 remaining cash secured puts, so I kept 1. Why I kept 1? Well, very simple. I did not want to have $14,500 in Intel, but I didn't mind having $2,900 in Intel because to me, my thesis still stands. The US needs its own semiconductor foundry. They do not want to rely so heavily on TSMC moving forward. So my thesis doesn't require Intel to come up with something new to beat Nvidia and something groundbreaking like that. They just have to not die on the product front, okay? Just release something that is, semi-competitive, competitive, and focus on being a US chips manufacturing company, and we're good. I can see this easily going back to the high 20s or 30s. And then so what I hope to do is that by holding this position, waiting for the recovery and showing you how I actually wheel this position using covered calls, we can exit a highly unprofitable position and exit it in a profitable manner. So let's do the math on this. Okay, you see, basically we sold the $29 Intel puts for about $1.40 each, right? Which means our average cost per share is about $27.60. So currently, Intel is at $19, so we are at a $8.60 loss. However, you know what? Because the brokerage I'm using, Momo, right, that they don't really count your premium into the cost basis yet, so it shows nearly a $1,000 loss. But once you offset the premium, that's how I got 860, which I show you over here. So either way, basically what we're going to do, because Momo doesn't track this, we're going to track this using the Excel file, and I'm going to show you the transaction history, and then we'll just reflect it onto the Excel file, right? So what we're going to do, as you can see over here, I've started doing it, is to actually sell a covered call against this position, which means that I'm telling somebody, you know what, I'm willing to sell you this 100 Intel shares at $22. Now, for that, they actually gave me 16 cents per share, which is $16. So basically on 23rd of August, if Intel is not above $22, what happens is I keep this $16 for myself and reduce my cost basis, and I do it all over again. However, if the Intel shares actually rise so quickly from $19 to $22 within these 2 weeks, which is actually a good thing if you think about it, because you're actually profiting from the capital appreciation, what I can do is I just roll the covered call out even further and probably at a higher price, and then basically collect premium again. So either way, we'll slowly make all of this back by selling aggressive covered calls and then waiting for the stock price to rise. Because when we do the real wheel strategy, I think one of the misconceptions people have is that all the premium that you collect is your profit. However, the truth is all that is just a form of cash flow, and the real profit comes when you hold the stock in the long term and you basically gain from the capital appreciation. Okay, and so that's basically all we have to say about the Intel position. And then we want to talk about the SoFi position. So remember, I actually bought to close the 4 cash secured puts, right? I basically bought to close them at $7.57. So that's basically a total of $3,028. So you less the initial premium that we received of $140 per share, right? Basically, we made a loss of about $2,464 lah. Right. So, however, that also released $11,600 worth of collateral. So this is actually a realized loss. We actually took the loss because I received $563 and then I paid back $3,000 to get out myself out of the contract. So this is not a paper loss. This is Intel loss is a real loss. So at this point, basically what was the strategy? Because like I was mentioning earlier in my previous video, if you're going into a recession, you want to hold companies that you actually have a high conviction with. And I do have a very high conviction on SoFi. Now, I know going into a recession, right, sometimes financial companies actually don't really do well. But the reason why SoFi is an exception for me is because coming into 2024, when you look at the management's guidance for the year, they actually tell you that, okay, this is how we expect to perform during the year. Why we expect to perform this way is because, number one, they expect US GDP to slow down. However, it's at 2.8% so far in Q2, no signs of slowing down. They expect unemployment to be above 5%. At the moment, it's 4.3%, so we're still relatively safe. And they expect some sort of recession happening this year. At the moment, like I said, the idea of a recession seems like it may come, but nobody knows exactly when, maybe even early part of 2025. So that still remains to be seen. And even if something comes in, basically they already tell us we already factor all of that into our guidance. So I feel safe holding SoFi. And that's why I actually increased my position in SoFi. Basically, what I did was to sell 12 cash secured puts on SoFi at basically about $1.80, I think. Was it $1.80? Let me take a look. So correct, I basically sold 12 contracts for $1.81, basically receiving $2,172. So basically, if you remember, right, what happened was just now we made a loss of $2,464. Now we basically made back part of that through this premium that we collected, $2,172 lah. But it is not so cut and dry. We didn't just receive $2,172. We're actually making back for the loss. Okay, so but basically now I feel more comfortable with that position, having 17 cash secured puts at about $1.73 average, basically going into 2025. Like I said before, because this is a high conviction company, I don't mind that. So basically, I've actually collateralized this $14,000 that I have basically for the long term. And then what I aim to do moving forward, just to make up the remaining loss, because you see, I lost 2,464, I made back 2,172. There's still a realized loss of $292. And how I plan to make that back is to sell short-term cash secured puts on certain companies like SoFi, probably higher conviction names like Palantir and Shopify going forward lah. So in terms of collateral, now I have about 13,600 collateralized in SoFi, but that is for 2025. So I'm not too concerned about that. And at $8, I think with some of the catalysts coming out with lower rate environments and things like that, I think we easily get past $8 by 2025. If not, I'll just roll these contracts again. Basically, one thing I want to let you know when you're running this wheel strategy, don't just look at the premium number. Although it looks like, wow, I made 2,100 over dollars just by selling this 12 cash secured put. Remember, it's actually to offset a loss. So I actually can't count this $2,100 as part of my monthly yield. So basically, I'm a little bit behind in terms of the monthly yield amount that I'm actually chasing after, but that will hopefully get better with time as I sell the shorter term cash secured puts on SoFi and other companies. And finally, the third company I want to talk about, which is PayPal. And then if you actually consider the current PayPal position, basically what we have is that we actually hold calls on PayPal for 2026 in another account, which is why I did not want to have additional exposure here in this account with Momo, right? It's such a small position, only 20 shares. So I basically had two options. Either I cash out, keep the cash at the side, preparing for a volatile next few months, or basically build this up into a 100 share position and to sell options against it. And when I look at the options chain, the premium didn't make it very worth for me to actually build this up into such a big position and to sell options against it, because the yield wasn't very good based on the premium that I was seeing. So to me, this is actually a good chance for me to keep some cash on the side, capitalize on the volatility, and to sell puts in the short term to basically make back the monthly yield. So that's why if you look at the portfolio so far, yes, we have Intel, but Intel is not a core position. We only have one core position, SoFi, which I plan to double it. So what we're looking for is another two companies that we can call core positions in this portfolio, such that we can at least hold 100 shares on and start to sell options on these companies as well. I think one of the things I probably need your help in, right, is that how we want to construct this portfolio, because I'm caught in two minds at the moment. Now, if I'm very honest, right, if I look at the market right now, some of the cheapest companies out there in terms of valuations are things like Google, Amazon, Meta. These companies have been so oversold after the recent earnings, especially Google and Amazon. I think it is a very, very big overreaction, and I think it's a good opportunity. And so these are my favorites. However, if you actually saw in the portfolio that I actually was holding the PayPal in, I also have Amazon. And basically what I'm hoping to do is not to duplicate my positions. So basically, although I'm tempted to use some of these 15,000 to buy into these big tech names, I have two problems. Number one, I do not want to duplicate the position. I want to actually find new positions. And then the second thing is basically because I want to run the wheel strategy. If I actually buy some of these shares like Google and Amazon, which are $100 over, I basically cannot own 100 shares, and then it's very hard for me to run the wheel strategy. Moving forward, I'll be looking at companies that I really like, I have high conviction in. I used to own some of these companies and then I sold them on the way up, which I actually honestly really regret. But I'm looking to get back into certain companies. However, some of these companies may not be currently undervalued at the moment compared to stocks like Google and Amazon. So do let me know down below in the comments what you prefer. Do you want me to just focus on looking at companies, like I said, within the 5 to 30 or even 50 billion market cap kind of range? Or are you okay with me holding on to bigger companies like Amazon and Google as long as they're undervalued and I do not need to hold 100 shares on them, and I do not need to necessarily run the wheel strategy on every single position in the portfolio? Unfortunately, two of the companies that I wanted to get back in, right, had very, very good earnings, and then their price basically spiked right after earnings, which is Shopify and Palantir. But we'll definitely be looking at them, selling cash secured puts at certain price points that I feel comfortable getting in again. I'll be talking more about those companies in the weeks ahead. But if you have suggestions of companies that you want me to look at, to consider for this portfolio, do let me know down in the comments below, and then I can always make a video on that, studying the company together and letting you know what I think about those companies. But other than that, I'll see you in the next one.